You're watching ET Markets Live. Welcome to a brand new episode of ET Smart Investor, where we discuss all about your investments and more. I'm Neha Vashisht, and our topic of the day is understanding SIPs in uncertain times. We have a lot going on in terms of tariffs, geopolitical risks, and much more. So, we are going to decode everything related to that. Joining me today is Chirag Muni, Executive Director, Anand Rathi Wealth Limited. Thank you so much, Chirag, for joining us today on ET Markets Live.
Thank you, Neha.
Well, the pleasure is all mine. So let's quickly start our conversation for today. And let's start with Trump first. Trump has, of course, come up with the 25% tariff on India. Is the market reaction to Trump's tariff on India an alarm or an opportunity for SIP investors right now?
So, yeah, like we've seen that a 25% tariff have been, put on the Indian imports by the US. But as of now, I think a lot of clarity is still to come out.
Mm,
Is why the market has actually not reacted too much. It opened up with a gap
yeah.
down, but then now it's recovered. But then you can't say because it's an expiry day as well. But if you look at it from a long-term point of view, I think still the undercurrent on the macros for India has been very strong,
Mm,
and of course there'll be some bit of impact in some of the sectors, but our dependency on US for exports is not large to that extent. Of course, we'll have to wait and watch and do the numbers, but the overall estimate is that the GDP might go down by about zero point 0.2 or 0.3%, if the full impact of the tariff comes in. Of course, there
mm.
is some penalty as well, which is unannounced right now, that if we keep buying Russian oil, then there will be penalty. So all of that needs to be seen. But if you ask me from a 3 to 5 year point of view, the underlying macros are looking very strong. India is in, and of course, there's a bilateral trade also which has been worked out. So once we have
Yeah.
all of that, I think things will be much better off than what the market is likely to react. So I think any downfall is more of an opportunity, and any dip I think should be bought in rather than being too much worried about the news coming in every day.
All right, let's also talk about investors right now. So, a lot of investors, a lot of people that I know also are kind of they are panicking in a way. But what will be your suggestion to those investors who have invested like a good amount of money in mutual funds right now, and they at this point they feel like, let me just take out my money. So, what is your suggestion to those investors, and also should investors continue SIP at this time or not?
No, absolutely. Like I said, for two things. One is people who have already invested into mutual funds. I think they should stay put. Look at their overall asset allocation. If they are overexposed to
Mm,
equities, then obviously they need to rebalance it. And when I say overexposed, they're upwards of 75-80% is when they should
mm.
look at rebalancing it. But if you're in the range of 60 to 70% into equity, I think not too much to worry. Of course, we'll have to watch, but not too much to worry. As far as the SIPs are concerned, definitely it's SIP is one method. We all know that is a very disciplined way of savings and investment. And the big
Mm,
advantage that an SIP gives is the rupee cost averaging, by which I mean that it takes advantage of all the volatility, right? So whenever the markets are up, you might get some lesser units of mutual funds, but whenever markets are down,
mm,
you may end up getting more units of a mutual fund. So when you average it out, more often than not, the average cost becomes much lower than the current point. To my mind, I think it's a very good opportunity. In fact, if there is volatility, like for example, last September we were at 26,200. We've come back to
mm,
about 25,000. So net market is not given too much. But if you see the journey of the Nifty, I think it's gone down to 22,000, come back to 25, was at 26.
mm,
So all of that, if you do a monthly disciplined way of investing, it is only going to help you to acquire more units. Just to give an example, if I just started an SIP in, let's say in January this year, for 7 months,
mm,
and let's say I bought it at 10 rupees NAV, for 10,000 rupees, then I would have got 1,000 units. And today, let's say
yeah.
the NAV is about 12 rupees, then I would get
Mm,
833 units. But if you had bought it every month, then obviously some were bought at 9, some were bought at 12, some were bought at 13. So the
mm.
average then comes down to about 10 and a half. So all I'm saying is, taking advantage of this is much better. So that's why SIP becomes a very, very good tool to continue.
All right. And for those who want to start an SIP at this point, do you think this is the right time for them or should they wait?
Again, I think we've always said, of course, timing the market is going to be extremely difficult,
Mm,
and of course, in these uncertain times, you always feel that you want to wait for some time, let the markets dip, so on and so forth. So, one interesting study we did is for the last for 25 years. If I had done an SIP into Nifty, of course, mutual fund gives some excess return, but if I just take Nifty as a benchmark,
mm,
and if I'd done it for 10 years at any point in time, for example, there were three investors. Let's say one would have invested, was the unluckiest investor, and always invested on the peak of the month.
mm,
Of course, that's not possible, but assuming that there was an investor, unluckiest investor, who could do an SIP on the peak of the month, and if there was an investor who did on the lows of the month, for 10-year period, of course, and if somebody who just done a
mm,
disciplined way of, let's say, 16th of the month, then if you see the difference, the person who actually did it on the peak of the month got about 11.19% average return, whereas the person who did it on the lows got 12.65%. And if somebody just did a disciplined way, it was 11.84%. So the difference is
mm.
0.4, 0.5%, and not huge. So, timing becomes very difficult. If the difference is huge, then of course it makes a difference. But we have seen time and again that if you're for a long term, the overall impact is very less. So I think you should not wait if you have savings, and you should definitely do your SIPs at these times.
All right. While we're at it, let's also talk about step up SIPs. We've talked about step up SIP earlier as well in our previous sessions. What are your thoughts on step up SIP right now? And considering the current situation in the markets, even if we take in account the global situation and domestic factors, all can step up SIP be a good option for investors at this point?
Oh, absolutely. I think it's one of the most beautiful tools, not utilized fully for many of us, because once I mean, good part is to start an SIP first. So that's the first
Mm,
step. But as in when we are in our income age, obviously we are going to grow our incomes over a period of time, and that's why you should save more. And if you are able to just top up your SIP every year, then it makes a significant difference. Again, if I to give you an example, let's say if it's an investor at 25-year age started with a
mm,
5,000 rupees SIP and
mm,
builds a corpus up to 60 years for 35 up to 60 years of age for 35 years, then the corpus would go to about 3.5 crores.
mm.
But if that same investor said that every year, if I just top up my SIP by 10%, so first year 5,000,
Right.
next year we are saying 5,500, so on and so forth. Then the difference is that the corpus would be 9.4 crore rupees. So almost more than
Mm,
double is what the corpus, just by adding that 10% bit that you're going to add. And if I have to take an example for let's say a 25,000 rupees SIP, I would reach
mm,
a corpus of 17.5 crores. Whereas for 35 years, of course. But if I did a 10% SIP, a step up there, then we're talking about 47 crore, a corpus. So almost a 30 crore rupee difference is what we saw.
mm.
So I think one should have a very disciplined way of doing their SIPs, and also ensure that do you do a step up of whatever you can. 10% is an ideal number, but if you can do more,
Yeah,
then of course you will have a better corpus.
right. A lot of investors, especially SIP investors, are very particular about certain things. Like they try to time the market, but of course, we all know that timing the market is very, very tough. Do you think timing your SIP on a particular date of the month has an impact on the return?
Fantastic question. I think one question always comes in every investor's mind. Which date should I pick up as my SIP date? It
Mm,
should be first, 7th, 14th, 21st. And now, of course, you get almost all the dates up to 28th for a investor to invest into an SIP with various schemes. So again, we did a study for last 25 years, and let's say you've done a 10-year SIP into Nifty and invested in
mm,
any on any date. So on every date, in fact, once, first, second, third, we saw all the dates. So the minimum return was 11.96% return. Sorry,
mm.
maximum return was 11.96, whereas the minimum was
Okay.
11.81%. So the difference is
Hmm.
only 0.15% return. You choose any of the dates. So I would say choose your birth date or choose any date which you like as per numerology. It's not going to make a difference too much. The more important part is that you're doing the discipline investment and building a corpus for yourself, which is reasonable. Again, the difference is not too much, so you should not be too much worried about a date.
All right. A lot of investors who want to invest in mutual funds are often confused when it comes to lump sum and SIPs. Do you think that SIPs perform better than lump sum?
So performance, of course, matters at what time you're investing, of course. But
Hmm.
again, we do data crunching on all of these things. One data that we saw that let's say if I had, every calendar year, let's say on the 15th I
Hmm.
started an SIP in Nifty, then what was my average cost? Or I waited for 12 months, accumulated that in my bank account, and exactly bought after 1 year. So, which is on, let's
Hmm.
say, 15th of December. And when we saw for each of these calendar years, 20 out of 24 calendar years said that SIP you got a better entry level because you averaged your cost.
Okay.
So 80% chance that you might end up being better in an SIP rather than just going lump sum, waiting for market timing, because again it's very difficult what is the right time. Similar study
Hmm.
when we did for last 10 years only, then it became 90% probability. So point I'm making is because in uncertain times the volatility is much higher, then the rupee cost
Hmm.
averaging works much more in your favor. And we know that a lot of times of course 24 years is a big period, but last 10 years or going forward also things are going to be quite uncertain, and risks are always there. So we'll see a lot of volatility, and that will in fact be an advantage to your SIPs rather than just waiting for some time and doing a lump sum.
Hmm. All right. So when we talk about new SIPs and new SIP investors, what type of time frame you think is ideal for them? Generally, whenever people start investing, they do not understand the market, so they come with a very short time frame for them, and then when they don't see the results, they get a little agitated. So, what do you want to tell those investors who have just started with new SIPs?
So again, it's very important that if you're starting your SIPs, you have to
Hmm.
at least have a minimum time frame of more than 3 years. Because if you
Hmm.
come with a shorter, time period, then you will always get disappointed, a very high chance. So when we saw this data that if I had done SIPs on a 3-year basis or any given point, the probability of getting at least positive returns is 90%. The probability of
Hmm.
getting 10% returns is almost 69%. But that's for a 3-year data. But if I just extrapolate it to 5 years, then your 10% return goes to 85% probability. And if I extrapolate to 15
Hmm.
years, it becomes 95%. So the longer the better, but a minimum time frame of 3 to 4 years. And if you don't have that time frame, then obviously you should not look at it. Another interesting data, Neha, we've seen is that whenever 1 year you've got a negative return on the
Hmm.
SIP, and if you just wait for 3 more years, the average return has been upwards of 11-12%. So, you should not get disappointed by looking at your negative returns. Like I
Hmm.
said, have a minimum period of 4 years, and you'll definitely get a much, better return.
All right. Let's also talk about rebalancing and reviews. Right now, we are seeing a lot of issues going on domestically as well as uh, globally also. Do you think this is the right time to review SIPs right now? And if yes, then how should one plan that review?
See, review is a normal process of any investment journey, and it's one of those times where you're just buying and waiting for it. You have to continuously monitor your portfolio. So, of course, when it comes to SIPs, the amounts are smaller. I'm not saying taking any action is important, but
Hmm.
obviously monitoring it every year at least and seeing that whether it's worked well, which are the schemes which have a likelihood of giving you excess return over your benchmarks. All of that needs
Hmm.
to be seen. Which are the market caps which are likely to do well? So some bit of study needs to be done whether I'm in the right scheme or no. And if the scheme is getting disappointed for a longer period of time, then obviously things needs to be rebalanced. So
Hmm.
monitoring is a continuous process, and that should be part of your discipline.
Okay. Let's also talk about large, mid, and small caps. So we know that large caps are less volatile than small and mid caps, but you make money in small and mid caps only. So, uh, what do you think about small and mid caps right now for SIPs? What should investors do?
So yeah, I mean, of course, the perception is that large cap will be always less volatile. But the if you
Mm,
look at mid cap, small cap, and if you give time to it also, then the volatility comes down substantially. One of the things that we saw, if you had done a 10-year, SIP returns from 2014 into, let's say, a large cap
mm,
category, let's say Nifty 100, then your average return was 12.6%. Whereas in mid cap, it was
mm,
16.8, and small cap, it was 14%. That's the average return. The maximum returns in
mm.
mid cap went to up to 22% as well. So, so I think have a good mix of all three market caps when you're doing your SIP. Depends on the amount that you have. But you can be skewed towards mid and small cap if you have more than 5 year horizon for sure.
Okay.
So that you get an additional return that you were talking about.
All right. So before we close, let's also talk about some mutual funds that can be looked upon in terms of a volatile market. Uh, are there any mutual funds you feel that are a good mix of all these caps, large and mid caps and small caps that we spoke about?
Yes, absolutely. So there are about 4, 5 categories that you should always look at. Do you get that excess return over benchmark? So I think in the large and mid cap category, DSP large and mid cap is one good category that you can look at or scheme.
Mm,
Then there is Kotak Emerging Equity in the mid cap segment. There is Invesco Small Cap in the small cap segment. There is HDFC Flexi Cap, which is in the
mm.
Flexi Cap segment, and then SBI Contra is what you can look at. So if you have a mix of these 4, 5 funds as a basket and do an SIP in each one of these, I think you have covered reasonably all the market caps and then also diversified your risks.
Okay. In terms of ideal market cap allocation, what would be the ratio in terms of large, mid, and small caps?
So I think currently looking at the current situation, Neha, I think about 55% in large cap and about
Mm.
20 to 23% into mid cap, and the rest of the 20% can be in small cap. I think this could be a good market cap split currently.
All right. Well, this marks the end of our segment for today. Thank you so much, Chirag, for taking out time and joining us today on ET Markets Live.
Thank you so much, Neha. Thank you for inviting me.
Thank you so much. Thank you, everyone, for joining us today.